Hello there, Hector Deville here. In this video we are going to be talking about one of the two specific type of setups or I personally like to try it whenever we are looking for 3 SMA trading opportunities. Alright, we have a number of concepts to talk about over the following minutes as far as, again, swing setups. We are going to be talking about confluences of support and resistance. We are going to be talking about the retracement trend lines. We are going to be talking about the actual pattern we are going to use in order to enter the market, okay, in order to trigger our trade, which is the breakout pullback continuation price pattern. Okay, and finally, obviously, we have to talk about targets and stop losses. Okay, basically where we are going to be exiting the trade either in profits or at a loss. Hopefully, more often than not, it should be for a profit. Alright, but at any rate, like I said, we have a few different concepts we're going to be reviewing over the following minutes, and then we'll be moving on to actual real Forex charts, so you see how it all looks like on, like I say, on real trading scenarios. Alright, okay, let's get going. Well, okay then, let's start off with confluences of support and resistance. Since I've pictured an uptrend here, obviously we'll be talking about confluences of support. In case we have a downtrend, we'll be talking about confluences of resistance. Okay, what's a confluence? Well, a confluence is basically an area in your chart where multiple different elements of support or resistance come together within few pips of each other. Alright, different elements of support and resistance that line up more or less at the same junction of the chart, strengthening each other. Okay, I personally like to pay special attention to 4 different elements of support and resistance. That's trend lines, counter trend lines, Fibonacci retracements, and previous swing highs or lows. Alright, don't you worry, we are going to explain them all in detail. Okay. Now, so far throughout the last few videos, we've established that we want to search for bounces of the dynamic area of support and resistance, okay, in order to, well, hopefully ride price for a whole new swing in the direction of the trend, right? Now we are implementing a whole new element. Again, they confluences. The idea here is that any of these elements, if we find any of those elements around the dynamic area of support and resistance, that's going to increase the possibility of a bounce, because now we not only have the moving averages, the dynamic area of support and resistance, but we also have some standard elements of support and resistance strengthening that signal, or rather strengthening the possibility of a bounce. So let's imagine that's a current market price there, okay, that's current price ticking in real time at this moment, and we've already determined that we are in an uptrend, right? Obviously, we want to search for long opportunities to buy into this uptrend. Okay, as we've already established over and over, we want to buy from the dynamic area of support and resistance, and that means that we need to wait for a little bit of a pullback for price to come back down here, and from there to search for our long opportunities, right? Well, now, as I was mentioning before, we are going to implement a whole new element into the equation. Standard elements of support and resistance in order to trigger our trades at the most optimal bounce point. The idea here is to draw those different elements of support and resistance, find which of them come along the dynamic area of support and resistance, and that's going to be our optimal entry point. Alright? Okay, trend lines. You draw trend lines in an uptrend by linking the different swing lows within that trend. Alright? Obviously, if we were downtrending, you would draw your trend lines by linking the different swing highs. Alright, linking swing highs, you have one trend line there, then you can draw this one there. Sometimes you will find that all the different swing lows do come in line, do come together, and therefore you can indeed link them up in one single line. Sometimes you'll find that, you know, the swings are not perfectly harmonic, and maybe this one may be a little bit longer, okay, that final swing, and therefore, well, you would have one trend line there you would have another, oops, sorry about that, linking these two swings there, you have another trend line there, then you can also link this trend line there, Alright, and therefore you have a third trend line. So linking different swings, you can obviously come up with different trend lines, right? Again, the ideal situation is that they all more or less come together in one single line. That's not always going to be the case. At any rate, you mark those trend lines that whenever you actually project them into the future, they come in line within or around the dynamic area of support and resistance. So if I have a trend line coming somewhere around there, by the time price retraces back down, that trend line comes somewhere in there, okay? And obviously, in order to reach that trend line, we would have to, well, break the dynamic area of support and resistance, touch the 100, etc., etc., and therefore I am not going to be interested in that trend line at all, okay? I only want to draw those trend lines that whenever I project them into the future, they come around the dynamic area of support and resistance by the time price retraces down. Alright, we are now looking into the sterling pound against the American dollar, 30 minutes time frame. As we can see, it's certainly a downtrending scenario with those moving averages pointing down parallel to each other, etc., etc. We can obviously draw different trend lines within this trend. I'm gonna mark the two most obvious trend lines. We have one there, okay, linking the beginning of the trend with that swing high, okay. However, as we can see, by the time price retraces up to, well, retest that trend line, we would have by then broken, first of all, the dynamic area of support and resistance, second, the trend line, the 100 moving average, and also we would have broken the swinging pattern, because if price is to retrace all the way up there, we would have taken the previous swing high, okay. Remember that in a downtrend you want to score lower swing highs, lower swing low, lower swing high, lower swing low. Remember harmonic swinging patterns, alright. So this is certainly not the trend line we want to take any trading decisions. We don't want to base any trading decisions off that trend line, because it's just not at the ideal location. So that's a trend line I'm going just to delete. Okay. Also, we can draw this inner trend line here, right? Linking that swing high there and this one there. Okay, now we can see how this one does indeed fall in line within the dynamic area of support and resistance by the time price retraces up to the to the dynamic area of support and resistance. So that's a good thing. Okay, you want to draw or to mark those trend lines that do fall within the dynamic area of support and resistance as price pulls back. Okay, so this is the trend line that I want to keep on my chart as far as searching for confluences of support and resistance, in order to, well, hopefully begin searching for bounces to the downside of those confluences around the dynamic area of support and resistance. And again, like I say, hopefully I will be using those confluences for a whole new swing to the downside. All right. Well, next one up, counter trend lines. Well, if we've defined trend lines as, straight lines linking the different swing lows in an uptrend or swing highs in a downtrend, all right? Well, a counter trend line is exactly the opposite. Is trend lines that link in an uptrend the different swing highs. Okay, not the swing lows, guys, but the swing highs. Let me give you an example. This one, for example, let's imagine this is price action and price begins to trend up from this moment on. Well, do you see how we can link these two swing highs? Alright, with these two swing highs, we have first of all this trend line, okay, standard trend line linking the swing lows in an uptrend, and now we also have that trend line coming there, linking the swing highs. So if price comes back down to retest that area, the dynamic area of support and resistance, we have this again, this counter trend line falling in line somewhere in there. All right, so basically this is the concept. You've probably heard this before. The concept of former resistance, once broken, may work as support once again. Okay, price comes back down to retest that former resistance line. Now that's broken, it may work as support, and price may bounce to the upside of that counter trend line, just as it may do of a trend line. Okay, so in this case we would have a confluence of this trend line and that counter trend line coming around that area. Do you see that, how they both fall in line more or less in there? So if price retraces back down, okay, obviously assuming that confluence is within the dynamic area of support and resistance, that would be a very strong area to search for bounces. Any bounce, okay, any price bounce that may happen of that area is going to be a strong bounce, because we have not only the dynamic area of support and resistance, but also those two standard levels of support coming in line, coming together, and therefore strengthening the signal. Okay, so that's the idea here, guys. The more elements we have in our favor supporting the bounce in our desired direction, the higher the quality of the trading signals will get as a result. Okay, we are back at our sterling pound against the American dollar 30 minutes time frame example. Okay, this is the trend line we drew a couple of minutes before. Now, if I actually zoom out, you will notice how we have two swing lows here. Okay, we can link them up with an actually let me do it with a straight line. With a straight line, I'm gonna mark that in red. Alright, and that's a counter trend line, just because in this downtrend, okay, we are now, the trend line was formed by linking swing highs within the trend. Okay, well, now we are linking swing lows, okay, two swing lows, giving us a technical line of former support now broken. Who knows, maybe whenever price comes to retest that level, let me actually now zoom in again, whenever price comes to retest that level, that line may work as resistance, and therefore price may bounce to the downside. Now, as you can see, those two lines don't come together, right? They don't come together. In order to come together at that area, the dynamic area of support and resistance, this line should come somewhere around there. Okay, that would be a very powerful trend line. A very powerful confluence. Okay, the dynamic area of support and resistance, the trend line, the counter trend line, etc., etc. This time around, it's not an example, a valid example, because they don't come together. Okay, we have, this is current market price, the trend line is somewhere in there, whereas the counter trend line is somewhere up there, and at any rate, it's above. Okay, it's beyond the limits of the dynamic area of support and resistance. So that's not a valid confluence as per the counter trend line. But at any rate, guys, I just wanted to show you with a visual example, okay, with an actual example, what a counter trend line is. All right. Many people don't quite look for those counter trend lines. They just focus on actual standard trend lines, and believe me, counter trend lines are just as powerful as standard trend lines themselves. Okay, so you want to search for those counter trend lines, especially if they come around the dynamic area of support and resistance. Very powerful stuff, guys. Okay, next one up, Fibonacci retracements. Now, explaining what Fibonacci is, or Fibonacci retracements are, is way beyond the scope of this video presentation. I could record a whole video on Fibonacci retracements. I will assume that you guys know what Fibonacci retracements are. If you don't, there is a fantastic article, the link to a fantastic article right under this video. Like I say, if you want to, get familiar with Fibonacci retracements, that's something you certainly want to read. Alright, at any rate, Fibonacci retracements are optimal retracement levels where price may retrace down to as per one specific mathematical formula, which is obviously the Fibonacci ratio. Again, I'm not going to explain that, but just for you to, just so we are all in the same page, I will just say that they are ideal retracement points. Okay, the way you calculate Fibonacci retracements is simply by measuring the distance from the lowest point of the swing, the beginning of the swing, to the very end of the swing. Actually, let's use this swing, for this explanation. We take the very beginning of the swing to the highest point of the swing. All right, and our Fibonacci tool will give us the different potential retracement levels. There are 5 potential retracement levels as per the Fibonacci ratio. We have the 23% retracement, the 38%, the 50%, the 61 and the 76% retracement. Okay, for example, the 76% retracement means that the distance from the highest point all the way up here is 76% of the distance from the beginning of the swing to the end of the swing. Okay, basically it tracks how far price has retraced back to the beginning of the very swing. All right. Now, I personally only look or I only pay attention to the 38, 50, and 61 Fibonacci retracements. I don't care for the 23 nor for the 76. Okay. I like to see my retracements to fall in line somewhere between the 38 and the 61% Fibonacci retracement. Now, that doesn't mean that I require my retracement to touch right to the pip either the 38, the 50, or the 61% retracement. As long as price falls within any of the, in between the 38 or the 61, it's okay by me. So I rather treat Fibonacci's as a Fibonacci retracement area rather than a Fibonacci retracement or a series or different Fibonacci retracement levels. I like to treat it as a whole area, again between the 38 and the 61. So I would mark the beginning of the swing, the end of the swing, then I would mark the 38, 50, and 61% Fibonacci area, and I want that area to be somewhere around the dynamic area of support and resistance, by the time price retraces down there. Okay, so I want to see my Fibonacci retracement levels giving me, or coming in agreement, so to speak, with the dynamic area of support and resistance. Okay, let's take a look into another current example. That's again current market price on the American dollar against the Swiss franc, 4 hours time frame. As usual, what we need to do, if we want to draw Fibonacci retracements, is to define the swing in itself, or rather, the beginning of the swing and the end of the swing. Obviously, of the latest swing. Right? Well, this is the latest swing to the upside, right? This is the beginning of the swing, and so far, this is the end of the swing. If we were to draw the Fibonacci retracements of the previous swing, well, that's obviously the beginning of the swing, and that's the end of the previous swing, right? So we would pick our Fibonacci tool, which by the way comes standard with any charting platform, right? And we would draw the Fibonacci retracements from the beginning of the swing all the way to the end, and as you can see, the Fibonacci tool draws automatically the 38, the 50, and the 61% Fibonacci retracements. This time around, price touches right to the pip the 61% Fibonacci retracement. That's great. Again, I don't quite require that mint perfect bounces of a Fibonacci retracement. As long as the bounces happen somewhere in between the 38 and the 61% band, it's okay by me. But anyway, that's in the past. What we now want to draw is the potential Fibonacci levels as per the latest swing, and that's what we are going to be doing right now. All right, there we are. So beginning of the swing, the end of the swing. So far, obviously, if price was now to keep on pushing up, we would simply need to readjust the Fibonacci retracement. Okay, that goes without saying. You want to keep your Fibonacci retracements up to date. However, let's assume that this is indeed the end of the swing. That's where price has stopped out, and well, we will see price retracing back down from this swing high point. All right, so we can see how the 38 Fibonacci retracement and the 61 Fibonacci retracement level more or less come in line, okay, with the dynamic area of support and resistance. Please mind that this is the dynamic area of support and resistance. By the time price, by the time price retraces back down, the moving averages will be somewhere in there, and therefore, they fall in line within the 38, and I mean the dynamic area of support and resistance, sorry, falls in line somewhere in between the 38 and the 61% Fibonacci retracement. So that's a good sign. Okay, again, you want to see the moving averages, okay, the 30, the 50 moving average, the dynamic area of support and resistance at any rate falling in line somewhere in between these two, that Fibonacci retracement area. Right, so as long as that happens, it's usually a good indication that we are seeing harmonic bounces, such as in here. Okay, such as in here. Let me bring back the Fibonacci retracement tool to measure the previous swing, okay, from the beginning to the end. As you can see, the dynamic area of support and resistance at this moment was in between the 38 and the 61%, so that's again a good thing. It usually indicates that we are seeing rather harmonic bounces. Okay, and as already mentioned on previous parts of the video, on previous videos on this module, that's usually a good indication. Okay, and finally, the previous swing high or low. Okay, swing high if we are in an uptrend, or swing low if we are in a downtrend. Now, the idea is to it's a pretty similar concept as what we've seen before, as per the counter trend lines. Okay, is the idea of former resistance. Once broken, price may now retest it from above and find support of that level.